Good morning, everyone. Thanks for joining today's webinar, Stock Option Plan Accounting and Tax Issues. If you look into your webinar pane, you'll see that the orange arrow on the right will allow you to minimize or maximize the pane. At the bottom of the control tray, you will see a chat window. Please feel free to submit any questions at the time throughout the webinar via chat, to chat with our presenters via the webinar. Next, let's take a look at your audio settings. If you're calling in through your telephone, please select Use Telephone. Alternatively, if you're using your computer speakers, please select Use Mic and Speakers. Additionally, I just want to share that this webinar will be recorded, and we will send out the slides as well as a link to the on-demand recording of the webinar within 48 hours. Please keep an eye out for this email if you're interested in accessing the webinar after today. With that, let's introduce our presenters this morning. First, we have Scott Borgia. Scott is a tax CPA partner at Armanino. Scott has over 28 years of corporate tax experience, including 17 years with Big Four accounting firms and 3 years with large multinational corporate tax department. Next, we have Tom Bondi. Tom is a tax partner at Armanino. Tom has been serving startups and early stage technology clients. He specializes in ownership of transition for funding of companies and stock options for the firm, as well as he assists companies and individuals in managing, implementing, and planning for stock options. Lastly, we have Scott Shorts. Scott is a senior manager with Armanino. Scott helps lead the equity management solutions practice. Scott has worked in legal and financial industries, providing financial and consulting services to public and private companies, as well as entrepreneurs. With that, let's cover today's learning objectives. Today, participants will be able to recognize different individual and corporate tax rules for a variety of grants, including ISO, non-qualified, and restricted stock. They'll identify the basics for calculating stock-based compensation, review the impact stock options have on APIC, deferred taxes, and income tax rates, as well as discover some of the equity considerations around mergers and acquisitions. Lastly, to give you an overview of today's presentation, we'll be covering U.S. corporate and individual taxes, accounting for equity awards, income tax accounting, financing considerations, as well as FASB updates. With that, we'll actually start today's presentation with a polling question for you. The question is, do you allow early exercise? Please make a selection in the pane in front of you. The options are yes on
non-qualified stock options only, yes on non-qualified stock options and incentive stock options, no, or we don't issue options.
We'll give you a few moments to make your selection.
And we're going to be talking more about this in the next section, so that's where the relevance comes in.
All right, and we'll go ahead and close the poll.
So it looks like about 37% of us do, so not a whole lot, but of the percentage that issue stock options, it's over 50% of the folks that issue stock options. So looks like a number of the attendees don't actually issue options. So I'm wondering if people are issuing restricted stock or some other form of equity compensation. So we'll be covering both, and we're going to go ahead and get started and talk about some of the individual and corporate tax issues. And this first slide is really a takeaway slide, but it covers incentive stock options, non-qualified stock options, as well as restricted stock awards and restricted stock units. A slight differentiation between RSAs and RSUs. RSAs are fully outstanding owners of stock, whereas the RSUs don't become owners until they vest. From a tax perspective, there is no tax at grant for any of these awards. And again, we're focusing on U.S. Tax rules, certain international jurisdictions, there is tax on grant, but we're not going to be getting into that in this presentation. When the option or restricted stock vests, there is only a tax on the restricted stock side, and that's at ordinary income rates. From an exercise perspective, the advantage of incentive stock options is that there is no tax upon exercise except for AMT, as opposed to non-qualified where you have to take ordinary income at the spread between exercise price and fair market value. Again, RSA, RSU, there is no exercise, really it's just at the vesting. And then from a selling perspective, you'll have capital gains on your ISO. If you have a qualifying disposition, we'll be talking about qualifying and disqualifying dispositions in a moment. Ordinary income for a disqualifying disposition, and capital gains on your non-quals and capital gains on your restricted stock when you sell those. And again, short-term versus long-term capital gains are going to depend on how long you hold that that security after exercise or after vest. So one of the items we want to point out, because we run into this oftentimes with our clients, is the $100,000 rule. IRC 422D basically states that you can't have more than $100,000 worth of incentive stock options. Again, those are the tax advantageous options, become exercisable in any one calendar year. So that doesn't mean that necessarily they become vested. It simply means that they become exercisable. This differentiation is important if you are allowing early exercise on your ISOs. That means that if you allow early exercise, all of those ISOs you grant that have the early exercise provision are all going to be counting towards that $100,000 rule. So if you issue 200,000 options at $1 each and they're all early exercisable, then 100,000 of that is going to be ISO and 100,000 becomes non-qual. Again, anything above that 100,000 gets classified as non-qual, and therefore you as a company would need to withhold and report income for those options once they were exercised. Most of the systems out there will split the grant for you into an ISO and a non-qual. Again, that split is only for tax purposes. The reality is that you're still probably just granting one option with one grant agreement, and you're going to have to do some math to make sure the calculations are correct. One thing to note is that you can split the grant in different ways. The tax guidance is a little vague. We interpret it using this method of the exactly, where you actually have to calculate the number of ISOs that would vest and hit the limit before you go to the non-qual. Some of the systems and some of our clients, just to simplify it, will just split that amount kind of evenly between the two halves and stay below the limit that way. Again, more beneficial if you actually take the time to do the calculation kind of tranche by tranche.
Okay, I guess that's me.
Sorry, no transition.
Yeah, no transition. Sorry, folks. All right, so this has to do with early exercise. So in this situation, you want to focus on, am I exercising prior to vesting date? And we'll cover a little bit about what Scott just talked about. So the early exercises can be often used for non-qualified stock options and restricted stock. This can be a big benefit for certainly founders as well as early employees. What you want to do is consider, what am I willing to put at risk? And then when you do that early exercise, you're looking at, what do I pick up as income? And the spread is going to be whatever the fair market value is on the date I exercise compared to the option price. There's a comment here about recommended to stop well before IPO, and that's because that price is going to go up dramatically on early exercise, and sometimes you don't have enough money to pay the tax on the exercise. 83B, we're going to talk about that in a moment, so I'll hold off on that. ISOs, sometimes we see out there, and looking at the poll, I see that there are a lot of folks that, whose companies allow early exercise on an ISO. Just so you know, an 83B election, which we'll talk more about, It is effective on ISO, it's effective for AMT purposes only, not for regular tax purposes. So it can become a nightmare for both the company and the individual who exercises on an ISO. And what that means is that you'll need to track throughout the entire vesting schedule what is the fair market value at each vesting date in order to determine what the income tax effect is going to be on you as a result of exercising that option, should you have a disqualifying disposition. A disqualifying disposition, I don't know that we cover that later on.
We will be.
We will be, so we'll come back to that a little bit later. But just in a nutshell, if you've got a 4-year vesting with a 1-year cliff, so you vest at the end of 1 year and then monthly vesting thereafter, if you have an early exercise on an ISO, you need to track the fair market value on each and every vesting date, so at year 1 and then at each month thereafter, and compare that to your exercise price, the option exercise price, to determine later on if there's going to be an ordinary income hit. It will become an administrative burden for the company as well as for the recipient.
And if you have any questions out there, I know we're covering a lot, and obviously we all love tax, and that's why we've attended the webinar, but the tax for stock options isn't the simplest. So if you do have any questions, feel free to put them in the box there, and we can go ahead and answer them for you.
Right. And if we don't get back to you on this webinar, we'll follow up with you. We'll be happy to follow up with you. So the next slide has to do with 83B elections. You want to make sure that this is where a lot of people get caught up. They don't file the 83B within the 30 days. My advice is don't get down to the wire. If, for example, you exercise on September 10th, don't wait till October 10th. Get it done in September so you don't miss the date. There's no extension on a 83B 30-day period from the time you do the exercise.
And that's calendar days, just to clarify,
right.
not business days. And ultimately, your employee is the one who's going to be penalized.
Right.
Again, it's their responsibility ultimately to fill out the 83B, but we do a lot for our employees, and most of the time the corporations will handle and make sure all that stuff gets filed to the IRS timely. But you want to make sure that you have that process in place to get that filed and into the IRS.
So you'll want to send those 83B elections off certified mail with the return receipt requested. It's in your best interest to put a copy with a self-addressed stamped envelope together, and the IRS will send back a stamped one. If you do not put a copy in there with the self-addressed stamped envelope, they will not send you back a copy. So your only proof is going to be the receipt from certified mail. Technically, you're supposed to attach a copy to your return in the year of exercise, even though a fair amount of people don't. It doesn't negate the election if you don't attach it, but it's a good idea to have it in there. You start the holding period for capital gains, again, assuming it's not an early exercise of an ISO. And then the trigger becomes, is it held long-term or is it held short-term after that? Just a note that on an early exercise of a non-qual, you do have a risk of loss there, that if you have ordinary income to pick up on an early exercise of a non-qual, if you later leave the company before the vesting date, the companies always have an automatic right of repurchase. When they buy those back at the original option price, you do not have a tax loss for the spread that you had to pick up in regular tax on a non-qual when you did the exercise.
Yeah, the other thing to note, again, we talked about RSAs, restricted stock awards versus restricted stock units. One of the differences there is that you can't do an 83B on a restricted stock unit. Again, because there is no transfer of ownership, and that's really when the 83B comes into effect, is when the ownership is transferred either from an exercise or the granting of a restricted stock award, an RSA.
Okay, next slide, we're talking about the timing of collection of taxes. This is for mostly on a non-qual or restricted stock units. This is a timing issue on vesting date. And so if you're going to exercise a non-qual, the amount of money you have to turn over to the company is going to be the exercise price plus the withholding taxes attributable to the ordinary income at the time of exercise. I know that everybody believes the stock price is never going to go down, it's only going to go up. But I would say when you're going to do these transactions, it's a good idea to exercise which you're willing to put at risk, because you may not have a liquidity event to be able to sell the shares. And Scott's going to talk about that in a moment. So you'll have federal and state withholding on income tax, as well as FICA and Medicare. If you have a 10b5-1 plan and any kind of shares are going to be put off into, or I should say, non-qualified deferred comp plan, if you're going to be deferring anything, you'll still have FICA and Medicare until you later receive the income back. So that's a whole nother subject we weren't going to cover today on non-qualified deferred comp, but you should keep a note of that to ask questions. And then on ISOs, we don't have any withholding, which is one of the attractive things in Silicon Valley on ISOs. You do have AMT, so you want to plan out so that you don't get caught with having too much AMT. That's a big issue, and so if you have a lot of shares, you want to make sure and do some planning on that.
Yeah, just to clarify, right, we had mentioned earlier the $100,000 rule. That has nothing to do with disqualifying or qualifying disposition. So if you're thinking, hey, earlier we said, that the ISOs over the 100,000 were required to collect and withhold, that is correct, because basically anything over that $100,000 of value is treated exactly as a non-qual. What we're talking about here is really disqualifying disposition, and we're going to cover that, I think, in the next slide, actually, after this one. So one of the ways to collect taxes, and this is more common with public companies, but there's two kind of main ways if you are going to do sort of a cashless exercise. One is a sell to cover versus a withhold to cover. So in a sell to cover, basically, we're selling shares into the market. Usually the broker is just selling it and then transferring the money back to the company to pay the taxes. In that case, the shares actually go out into the market. So if I have 100 shares and I sell 20 to cover the taxes and or the exercise price, the 100 shares are all still out in the marketplace. Conversely, if I do a withhold to cover, the shares are quote unquote bought by the company. They get retired by the company, and the company simply uses cash out of its coffers to pay the taxes and potentially to pay the exercise price, although there's nobody to pay, right? They're just technically buying them internally. But the tax man does want his money, and so the company would have to pay the tax man cash. In that case, the shares never end up as outstanding. So in the example of 100 and then we withhold 20, in that case, only 80 shares actually end up outstanding from an EPS perspective and from a dilution perspective. Depending on your plan, and we're seeing a little bit more frequently that these shares that are withheld to cover go back into the pool to be reissued, but it really depends on the plan parameters. So what we're talking about here is really a dilution versus cash flow question. So do we want to kind of let the market pay for the taxes and have more shares out in the marketplace? Or are we comfortable fronting the cash to pay the taxes and reducing the dilution there? Again, this is a question that comes up for pre-IPO, companies that are going to IPO, or if you're a public company. One thing is that we don't recommend allowing your employees to choose one or the other. This can become challenging and hard to maintain.
One other comment on that is that when you're not a public company, it becomes challenging for a company to allow a withhold to cover situation unless the company has adequate cash. So the company should be determining, are we able to do this? In some situations, they're not able to withhold to cover because they don't have a lot of cash, and so you're going to want to know, if you're the recipient, what's going to happen to me if I want to early exercise. Do I need to come up with the exercise price plus the withholding taxes, or is the company going to allow me? Because basically they're taking the cash and they're remitting it to the tax agencies for you. So good thing to know up front for your cash flow management.
Yep. And so we've been talking about this ISO disqualifying disposition a lot. Really, it's pretty simple. Basically, an employee must hold the shares that they've exercised. They can't sell them until 2 years after the ISO was granted and 1 year after the ISO is exercised. If either of those rules are broken, then it becomes a disqualifying disposition. These transfers to spouse and joint tenancy are not disqualifying dispositions, so those are some exceptions. And again, if you do have a disqualifying disposition, you don't have a withholding obligation, but you do have a reporting obligation. So you will need to put that W-2 income for your employees.
So we were talking about that on early exercise of an ISO. So that vesting date that you're going to map out over the, if you were to do an early exercise in ISO, you're going to need to track it, because at each of these vesting dates, you may have a substantial amount of ordinary income as the price of the shares go up during your vesting period. So you want to be aware of that. Once you meet the 2-year and 1-year period from the date of vesting on those early exercise of ISOs, then at least you've gotten beyond the disqualifying disposition period.
So we're going to just walk through a quick example here. Basically, in this case, a participant has exercised has a grant with an exercise price of $2. The fair market value or sale price, again, depending on when the timing we're talking about, is $5. And if they've sold it immediately, right, then there's going to be $3 of ordinary income. So if you do a same-day sale, you're basically treating it as a non-qual. So now if the value has increased from the time I exercise to the time I sell, the value has increased to $10, but I'm still within the holding period and I have a disqualifying disposition, I take the ordinary income, which is the spread between the fair market value at exercise price or sale, the lesser of the two. So I have ordinary income of $3. In this case, I have a capital gain of $10. The increase. In the case of a declining grant, right, where the price has gone down, I have ordinary income of $2, and that's it. And that ordinary income of $2 is the difference between my $4 of the market price when I sell and the $2 exercise price. And then lastly, assuming that the price actually goes below my exercise, I have no income, but I have a capital loss because I've now sold for something below what I paid for it.
All right, so now we're going to cover some of the payroll and withholding issues here. The companies need to issue a Form 3921, which will report, this is fairly new over the last couple of years, where the company has to report to the optionee, the individual who did the exercise, what is the value that is being used at the point of exercise for the ISOs. And this is to enable the individual recipients to have a definitive amount that they're reflecting for AMT purposes, as well as any other transactions. So that needs to come out to the employees by the 31st of January. And again, this is only an ISO, so it only affects employees. And then on the NSO exercises or restricted stock vestings, it's either going to be a W-2 reporting or 1099 reporting. Want to go to the next slide?
Yep.
Okay. So let's see. All right. So tips collecting. We've got stock administration team has to manage the collection and reporting of payroll. This can be quite tight for a larger company where you've got to manage a lot of different options and shares. This is where you're going to want to be on a system other than Excel to get this going, because there's so many different points that you have to map out when there's transactions going on. In the moment of processing, you've got to have the payroll withholding to be very timely, and so there's due dates of when the payroll taxes are due. It's a really important thing to start educating employees, ideally before their RSUs become vested or before they start exercising their options. A lot of companies often don't tune in and give education to the employees or optionees early enough, which causes a lot of conflict, because you want to give people the ability to determine the timing of when they want to exercise their options and hold them. Certainly if they're public, they can always flip them.
Yeah, one thing to note, if you are on an equity admin system, many times you can integrate payroll or your HRIS system into that system and gain some automation that way. And just to retouch on the education piece, that is a big piece. And Tom and I go into clients and present to their employees really to help them on that front and get them ahead of the game so they understand the tax impact, they understand the holding and all of that.
So here on this slide, we've got, let's see, what do we say here? Equal to employee W-2. what happens is technically the disqualifying disposition, the ordinary income from a disqualifying disposition would often be on line 21 of your individual return as ordinary income from an ISO disqualifying disposition. However, because the disqualifying disposition triggers a deduction for the companies, they will most often have it on your W-2, which makes it easier for you to track. One of the keys here is, as the recipient, you want to make sure that you do a reconciliation so that everything is properly reported on both your W-2 and on your tax return, because in this case, when you have a disqualifying disposition, you're going to have it reported on both page 1 of your tax return on ordinary income as well as on Schedule D, and you just got to make sure that you pick up the basis properly. One other comment on here is that if you received an option grant before when you were not an employee, when you became an employee, the character doesn't change. So you would not have withholding on that option grant when you exercised.
That's a great point, actually, the split. And if you do have an employee that converts from non-employee to employee, that the time period is how you split between 1099 and W-2. So we're going to get to our second polling question.
All right, great. So the second polling question is, which of the following is not a tax form associated with equity compensation? Please make one of the 4 selections. I'll give you a few moments to answer.
So far, we're doing pretty good. Let's go ahead and wrap that up. That's how well you know your forms. The answer is 4562. So again, Tom talked about on the W-2, there's going to be any non-qualified exercise or restricted stock vesting is going to be on the W-2, and then the 3921 is that ISO form that has to be filled out. If you have any ISO exercises, you have to fill that out and issue a participant statement to employees by January 31st of the following year, and file with the IRS by March 31st of the following year. Again, we can help you with that. We find that a lot of clients have forgot to do this in years past, or are looking for help to do it this year. We can help you with that. So we're going to really quickly kind of dive into some of the accounting associated with ASC 718. Again, we have a whole session on this, so you can go to our website and download the presentation. Really, we're just going through this to lay the framework for the income tax accounting, which Scott Borgia is going to talk about here in the next 5 minutes. So there's various pricing models. Black-Scholes is the most common because it's the easiest to use. But for more complex awards like performance awards, you might have to use a lattice or a Monte Carlo award. We're then going to talk about classifying awards, the requisite service period, and the amortization. So Tom kind of hinted at this. Employees get treated differently from non-employees. But a nuance is that non-employee directors are treated like employees, right? They get grant date fair value and there's no revaluation. As opposed to our non-employees or our consultants or advisors, they get revalued every period, what we call mark to market. There's also equity versus liability accounting. So liability accounting also gets mark to market. The difference there is that liability accounting, even if the award is fully vested, you'll still continue to revalue that award. And that's cash settled awards, or sometimes cash settled awards in substance means that if you always, when somebody exercises, you always buy out their options, you may be creating a cash settled award and creating a liability that you didn't intend to. You have to watch out for modifications. Any change of a grant term is a modification and likely has an accounting impact. So talking about requisite service period, over the last couple of years, there's been a development and a change of thought. And so the grant date versus vesting start date is an issue of, do we start accounting for an option when the vesting start date happens, even if that's before the grant date, or do we wait for the grant date? And the question is, on grant date, do we take a catch-up of expense, or do we start recording expense, amortizing expense over a shorter period? We've really, in the SEC and the audit firms, have really transitioned into, let's not take a catch-up on grant date, even if the vesting start date was 2 or 3 months prior, but instead let's take the expense over a shorter period. So if it has a 12-month cliff and we're, at the time of grant, we're already 4 months into that cliff, let's take 1/8 of the expense over the next 8 months, as opposed to taking, 4 of the 12 months immediately on grant date. A couple other options you have, and again, if you're going to change these at any point, this is an accounting decision that you'd want to change most likely at the beginning of the year, and you're going to have to explain and document and also analyze the difference of the methods, the accounting method change. Straight line is just expensing options evenly over the vesting period. But remember, you must record at least what's been vested. Oftentimes, people forget that a front-loaded grant doesn't expense straight line. It actually is going to take more expense up front because we have to record at least what's been vested. Graded expensing is where we treat each tranche as if it were its own grant. So the first tranche gets recorded over month 1. The second tranche begins recording at grant date, but gets recorded over 2 months, and the third tranche at grant date, but 1/3 in the first month, 1/3 in the second month, 1/3 in the third month, etc. The other item is you can do a single versus multi-life. Again, 95% of the companies out there do single life because it's simple. If you are using IFRS, you would have to use multi-life. And then forfeiture, again, most companies are kind of moving toward this at forfeiture. But again, some of the systems, especially the legacy Equity Edge users, you were probably using at vest. And this then causes you to have a true up every time there's a vesting date. It's really, in my opinion, not in line with GAAP, but many companies are still doing that. We've seen a number of projects where we're trying to convert people off of this at vest method to the at forfeiture method. And there's different ways you can apply the forfeiture rate: flat, dynamic, hyperbolic. Do you just use a 10% rate across the board? Do you use a rate that changes depending on how close we are getting to vesting? Those are some of the other options out there as well. Last thing, really just get your advisors involved when you have equity transactions. Scott and I were working with a client the other day. They were talking about doing a repricing, and they wanted to know the impact both from the accounting side as well as from the taxable side for the individuals. So, if you're having an event, make sure you get the right folks involved and get them involved early. Definitely your auditors, but also your tax folks.
All right, with that, we'll jump into polling question number 3. The question is, how do you record stock-based compensation expense today? Is it A, Excel, B, an equity system, C, we don't yet have a SBC expense, D, we're not audited yet, or E, I don't know? Give you a few seconds to make your selection. All right, with that, let's close the poll.
So it looks like about 1/3 of the folks are using Excel, 1/3 of the folks using equity system. Not bad. Apparently we have a number of folks that are just kind of trying to learn about and maybe looking to roll out an equity system, or excuse me, an equity plan in the next few months or year or so, and so they don't have any stock-based comp expense. Ultimately, by the way, if you are issuing any equity compensation, you do have stock-based comp expense. You may just not know it. So hopefully that's just people that haven't rolled out a plan yet, but it's a good mix there.
All right. They finally gave it to me now, so thanks. We're going to talk a little bit on income tax accounting, just some real basic principles maybe in the beginning. The income tax accounting or the tax provision as it's otherwise known is really viewed in kind of 2 key areas. There's the current portion, that which is associated with what you're estimating the current year you're going to pay or get refunded, versus the deferred portion, that which in the future will be either a future tax deduction or income. And so we're going to make reference to the DTAs, the deferreds, throughout the coming slides. And we're just noting as it relates to stock comp The deferreds can change, obviously, if you lose through cancellations or that, some of your options. So you would reduce your deferreds then. The other piece to emphasize really is looking at, there's a timing difference as it relates to certain book versus tax expense. Those things that will in time just turn versus a permanent difference, which will not. And that has a much greater impact to the rate. And so there's a lot of sensitivity around permanent differences. Okay. So what then happens at the time of grant and then the subsequent vesting, when books is going to be recording then the expense, at that point in time, tax generally, there is no yet event other than we're going to have, for a non-qual or restricted stock, we're going to set up the DTA based on the book expense, and we'll set that up using the federal and state rate. For an ISO, on the other hand, there is no deferred setup, because you cannot presume that there will be a disqualifying disposition. So that is otherwise than a permanent difference. We're just noting on the next point that as your rate changes, and that's generally going to be in the state area, then you would adjust your deferreds accordingly. And always, as it relates to deferreds, being aware if there's a valuation allowance to take your deferreds down, that then is determined in the future based on how the company will likely use the deferred based on future profitability. So now at the time of settlement then, which is when you would have your tax event, what happens? So with an exercise or vesting, and when you have, in this instance, we'll talk about the windfall side. A windfall is when you have your tax benefit is greater than your deferred. So in that instance, to the extent that you've booked the deferred, you need to reverse it, and then any excess amount you would generally credit to APIC. To the degree you have a valuation allowance against the deferred, you would not yet book that credit to APIC. This also would be where you would begin to track what's called your APIC pool from those windfall tax benefits that will be used to offset shortfalls. As it relates to an ISO, any prior permanent difference that was booked, to the degree you have that you have an excess, you're going to reverse up to that same book expense, now going the other way, and then that excess benefit will be credited to APIC. You do not, under footnote 82, record any APIC credit until there's actual reduction of taxes payable. This is specifically geared towards NOL carry forwards, where you may be taking the deduction on a return, goes into an NOL, but until that NOL actually gets benefited, it wouldn't yet result in an APIC. So how do you determine when to record the windfall benefits? Some of you, I'm sure, have heard there are there's two different approaches. The one most often used is the with and without, where there's a hypothetical analysis that tracks your windfall tax benefits when they are deemed utilized, and they are deemed utilized last in this instance. This then puts the APIC hit until the end. You first have to go through all your without NOLs in this instance. The other approach is your tax law ordering approach, which really just follows the tax return and the benefits allocated based on the tax law and how it is utilized, deemed utilized per the tax return. This results then in the APIC being recorded earlier. The key is that you make a decision for the company. It's an accounting policy decision, and then you follow it consistently. Now we talked windfall, now let's talk shortfall. So a shortfall is then on the other side where the tax benefit is less than the deferred. You still have to reverse the deferred, and then the debit would go to APIC to the extent there is an APIC pool. If the pool's been reduced to zero, then the tax expense is hit. If you're in a valuation allowance, again, there would be a suspension of any APIC or tax expense hit. For an ISO, you just have a smaller permanent difference to reverse on the disqualifying disposition. We've talked about this a little. This is a very detailed area. You are required to track this on an option by option basis. People in the beginning may start with an Excel spreadsheet, but you can imagine how quickly that gets pretty difficult to track, especially when you start trying to also track any reporting requirements, withholding requirements. You really need to get to more of a software package and look to have others help you. All right, polling question 4.
Yep. This is our last polling question today. The question is, what level of income tax accounting do you record today related to equity grants? Is it none, we're in a net loss position and don't disclose anything? Tax footnote disclosures only? Income tax expense only as paid? Everything, deferred tax assets, income taxes payable, tax. Sorry, that got cut off at the end. Or the last option, none, we don't know where to begin. Give you a few more seconds. All right, let's close the poll.
So it looks like we have about a quarter of the folks that don't record anything. About a fifth of the folks just to record the disclosures. Income tax expense only as paid, about 5%, and then 25% record everything, which is great, and none because they don't know where to begin. Well, hopefully this is going to help you and give you more insight into where to begin. So kind of all over the board there in our polling question.
All right. We're definitely here to help. So, and by no means is this a detailed dive in the rules. This is very complex, but we hope this is providing a good overview for you, and certainly let us know if we can help with any further questions. So maybe some other items we just wanted to make sure we emphasize as it relates then to NOL carry forwards. There is no deferred that is booked for the NOL portion due to the excess deduction. So you'll often hear reference to you only record the without NOL as a deferred tax asset. The with NOL, that which has the excess amount in it, is on your tax return, but it is tracked separately. So you do have to make sure you distinguish between the two. The other item to note is there can be other indirect effects of your stock-based comp. This can also happen with regards to your Section 199 deduction, which is the domestic production activity deduction, or your R&D credits, where there's ordinary income being reported associated with R&D employees from options. You really have 3 options there. There is the with and without approach that you can do similar to what we've discussed previously. There's what's called the incremental method, and frankly, the third most popular one is just don't deal with the indirects, because it's just how far do you want to go in creating your even more complexity. So maybe a real brief comment on interim reporting. Just be aware that any windfalls and shortfalls are discrete in the period they occur. You don't estimate out for the remainder of the year, just only when they happen. Disqualifying dispositions are also discrete. So let's take a quick example just so everybody can put some numbers to this. If we assume fair value of 1,000 options is 20,000 with a tax rate of 40, and the spread is 10,000 based on a 30,000 settlement value. For a non-qual restricted stock, you would have at the time of the book expense being recorded, you're going to book 20,000. The tax benefit as you set up the DTA at 40% will be the 8,000. So your after-tax cost is 12. Now at the time of that excess tax benefit, that 10,000, you'll then take that 10,000 times the 40%, and that will be your APIC entry, the credit. And you'll see under the ISO disqualifying disposition, you really get to the same answer when you are in a windfall. On the other hand, looking at a shortfall, you'll see that there is some difference between the two equity types. So still looking at the 20,000, we'll still be setting up that benefit of 8,000 in the deferreds. Now what happens when we settle for less? We're going to have, with that 5,000 difference, we're going to have a debit to APIC. To the extent that we have the pool, we'll hit the pool. Otherwise, it'll go to income tax expense. When you look at the ISO disqualifying disposition, we're only taking the benefit up to the amount of the actual deduction, which is going to be realized. So that's only the 15. So the 15 at the 40% is the 6,000. So you can see in this instance, there's actually a little higher after-tax cost on your financials. Now, what happens under a forfeiture or expiration? We kind of already touched on how the stock-based comp gets adjusted for non-vested. In essence, the book charge isn't really happening until it's vesting, so it's not been yet set up in a DTA either. So it's already effectively been reversed. On the other hand, with a vested, the stock-based comp doesn't get reversed. So now you've got this deferred that's sitting there that'll never reverse otherwise from a settlement. So you've got to then write it off. You got to take down your deferred, and you first do that to APIC, and then you do that to the income tax expense. Again, if you're in a VA, that impact will be suspended.
All right, so just mostly this slide here addresses primarily pre-public companies, early stage to mid-stage maybe, but still private, where some of the challenges that companies have are if they don't have a type of plan that enables them to reward individuals, they may have it difficult to not only attract employees, but if they're not tracking their equity comp or their equity plans well enough, they might have some confusion and be unable to track investors. They want to be able to also understand what they're giving up in terms of dilution, which relates to the amount of control desired, because it's that management team that everybody is investing in to make sure that they can carry out and execute on the plan of the company. So if you have a sloppy plan management, you're going to find it difficult to manage the dilution that investors are looking for you to do. You want to be able to plan ahead, have options available in the pool, and to be able to use them for future hiring plan. This gets to how do you keep the board apprised of the future hiring needs for determining the size of the option pool you want to have. And then the other is that over diluting the founder's ownership can inadvertently, through a poor plan management, cause the management team to leave or depart, which throws some confusion toward the investor's way. So basically, I think I want to encourage you to implement a cloud-based system as early as possible to allow ease of use of tracking for the board, for accounting and tax issues, as well as for employee access for their own determining of when they should exercise options.
Yeah, one of the things that excuse me, that Tom always talks about is when you go to the investors and you have that 3-year operating plan, part of that plan should be your hiring plan and your equity issuances, right? What are you expecting who are you expecting to hire, and what is that going to cost you from an equity perspective, from an option perspective? And investors are going to be looking for that, and you're going to have challenge managing that and maintaining that with a messy cap table and disparate service providers in that case. One of the other things that we've been seeing more and more often when it comes to financings, and that's really what we're talking about, some of the considerations around when you're heading into a financing or you're trying to find financing, is secondary transactions. So trying to find or trying to get liquidity for your founders, or maybe it's your entire employee base. Again, we talked a lot about disqualifying dispositions today. Be aware of that. A lot of times there can be a huge impact on your founders. They may end up with a ordinary income, which they might not otherwise have expected because they were granted ISOs. The other thing is that if you are doing net exercises for participants, so again, you're a private company, you might not normally do like a withhold to cover or sell to cover. You might start doing that or just buying out options, there's still going to be a tax withholding obligation, ordinary income and a tax withholding obligation. And again, that ISO disqualifying disposition that you have to analyze and review as well. The last piece is the 409A valuation impact. So any type of third-party transactions, right? Normally, if a VC or private equity invests in you, that purchase of preferred stock is going to impact and be part of the 409A valuation. Well, now if you implement a common stock transaction, there's also going to be some consideration put towards that and your 409A. And it's likely going to increase your common stock value, assuming that people are getting paid pretty well for that secondary transaction.
We just wanted to also make note of a item to consider when there's a lot of stock issuances going on, from exercise of options, secondary offerings, preferred rounds, and that. A key area of sensitivity is what's called the Section 382 area, the analysis. 382 was enacted early on when used to be companies would just sell themselves for only their NOL, that they otherwise had no substance. So 382 was enacted back in 1986 to prevent the sale of a corporation solely for the value of its tax attributes. It includes many anti-abuse provisions that can surprise companies that otherwise have no intent to be, selling their NOLs for money. What happens then? In that situation, your NOLs and credit carry forwards can become subject to an annual limitation as to how quickly they can be utilized. The limitation is triggered when an ownership change occurs due to the company's 5% shareholders having an increase in their ownership of greater than 50% at any testing date during a 3-year testing period. So you're continuing to monitor this. The percentage ownership is based on the value of the stock, and so that's where it also adds another element of challenge, just trying to distinguish how do I value my different stocks. Common triggering events for a testing date will include any issuance of stock, preferred, secondary, and options. So you're always to look at your various testing dates and seeing where you're at with regards to approaching a greater than 50% change. The rules are extremely complex. Armanino, we have those who specialize just in that area because it is that important and it's that frequent where you have to really understand where you're at so that you don't trigger unnecessarily a ownership change that could have a very negative consequence to your attributes.
Yeah, everybody wants to preserve those NOLs, and that's really what we're talking about here, just making you aware of that, because financings are going to be one of the big items or events that we have to look at in analysis. So now we're going to get into some updates. So the FASB over the last couple of years has been, I guess, trying to simplify ASC 718 and as well as some of the tax codifications around stock-based compensation. So a couple of things. One item that did come out earlier this year and got implemented was on performance awards and the fact that you can have performance after a service period. So that's already been rolled out. But these are some of the ones that they're in discussions and probably would get implemented either late in 2016 or maybe in 2017. But allowing you to withhold at the employee's maximum rate as opposed to the minimum rate. Typically, you had to withhold at the minimum rate. Otherwise, you had to record that stock-based comp as a liability, and you had to revalue it and market to market, as we talked about. Another area is that they're looking to align some of the codification between public and private on the put and call. So if you have a repurchase feature, they're trying to align that so that it's the same for public and private companies. And now you can actually consider the probability of occurrence to determine whether that's an equity or liability award. So if it's probable to occur, then it's going to be a liability award. If not, it's going to remain as an equity award. And then again, they've done some items with private companies, or they're trying to. It'll be interesting to see how this really plays out, because If you're a private company that ultimately wants to go public, I'm not sure how you're going to really be able to utilize some of these, or maybe you will initially and then you're going to have to convert. But the SAB 107 simplified method, which allows you to just look at the vesting period plus the contractual life and divide by 2, basically the midpoint between the vesting period and the contractual term. They're looking at actually now being able to apply that to performance awards, and which actually makes it a lot easier, because performance awards, a lot of times you may have to use a lattice or a Monte Carlo or something else to value when you expect that option to be exercised. Again, the implementation of that compared to if you're going public is going to be a challenge. And then also for liability awards, so if you do have cash settled awards, you would be able to use intrinsic value as opposed to revaluing that award on a Black-Scholes or on a fair value basis every period, every reporting period.
As it relates to the FASB's efforts to simplify, they have also looked at the income tax accounting area, and in particular the current treatment from what we just talked about, that would how to recognize the windfalls and the shortfalls through APIC. Under the proposals right now, and they've been out and are already receiving comments from companies, their proposal would have all the windfall and shortfall recognition to go through income tax expense or benefit, eliminating the need for the pool and significantly reduce complexity, but as we'll see, would have a increased volatility in the effective income tax rate, which is why we're seeing in the next bullet point that most of the comments are coming back from the companies as, no, we don't like this answer because it's going to create a lot of volatility in our rate. And that, you can imagine, to a CFO would be very stressful. So instead, the recommendations seem to be coming back. How about we just take them directly to APIC, forget about the APIC pool, but we'll go directly to APIC with those windfalls and shortfalls. So that's being discussed. Still remains to be seen when this would happen. Maybe 17, the most likely. They've also made proposals on changing the cash flow presentation to remove some of the complexity and, frankly, difficulty in how people understand how to record the excess benefits. So we'll keep our fingers crossed on that.
So just in conclusion, we definitely covered quite a few topics here, but I think the bulk of what we covered was on the corporate and individual tax side, some income tax accounting, and then here at the end we talked about some of the financing considerations as well as the FASB updates. If you do have any questions, please let us know. We'd be happy to answer any questions you have out there.
Yeah, if you have any questions, please submit them via the chat window now, and looks like we have a couple minutes left. And I just want to remind everyone that a copy of the slides and a link to the presentation will be sent out within 48 hours.
Yeah, so just one question here. Somebody asked about the 83B election and when do I use that? What's the benefit? I mean, ultimately, it's associated with an early exercise or with a restricted stock award. And you would, if somebody early exercises and they want to accelerate their tax recognition, meaning that they want to recognize the tax at that exercise or at the beginning, at the grant date for an RSA, they can do that and calculate the difference between the exercise price and the fair market value. So one of the benefits there is that if your exercise price is $1 and your fair market value is $1 on grant date, and I exercise, I have no ordinary income on that at that point in time, and that's really the benefit. And the other key benefit is that I start the clock on my capital gains tax. Again, we talked about it, but you want to be cautious on the ISO side. There can be some challenges there related to disqualifying dispositions when you allow early exercise on the ISO side.
All right, and on the next slide, what you'll see is all of our presenters' information, should you have any questions for them. I also want to remind you that as you exit our webinar today, you'll be prompted to fill out a short survey. The survey helps us understand whether the content was useful and how we can improve next time. With that, thank you so much for attending, everyone. We really appreciate it, and have a great day.